The most important macroeconomic force in industrial countries right now is monetary policy. What the central banks are doing, the central banks are keeping interest rates very low. They are, in my view, going to continue with quantitative easing for the foreseeable future in the United States and in the euro area. And that's going to have a big impact on short-term interest rates and, I think, longer-term interest rates. Well, some real pressure points right now in terms of emerging market debt. The crisis in Brazil is very important. There's still plenty of events unfolding in China, for example, and that affects financial flows. It affects commodity prices, and that's going to affect a lot of countries that borrowed on the expectation that, for example, oil prices would be high. I think there's something of a structural shift. I think that the capital is flowing more from industrial countries towards emerging markets, more than in the past 4 or 5 years, for example, in part because commodity prices are low. And so credit spreads will be higher for some issuers in emerging markets. Well, India is doing well. It doesn't get talked about a lot or even enough, but that they are continuing to make some impressive progress. There's been good results in some parts of Africa. Nigeria has had some impressive results, but I worry there that the exposure to oil is going to create also some vulnerability. And of course, we've had some standouts in Latin America. Chile has done remarkably well. But surely they're going to be affected by developments in that region in the near term. I think U.S. interest rates are going to rise to some degree, but slowly and not very much. Obviously, anyone who's highly leveraged, including the financial sector, has got some exposure there that they hopefully have hedged, but we'll see what happens. The U.S. corporate sector doesn't have that much leverage. There's certainly some vulnerability in households. In 1982, of course, when U.S. rates increased, although it was a bigger increase back then, there was a big negative effect on emerging markets, including commodity exporters. And I think we're waiting to see whether some of the more fragile borrowers, for example, countries that have developed oil in western parts of Africa, whether they're going to encounter difficulties. Well, there's certainly I wouldn't call it a coordinated approach to monetary policy, but a somewhat unified or parallel approach. Look, the central banks in all countries are responsible for their own countries. They're not responsible for the system. In the United States, the Federal Reserve has a statutory responsibility to get as much employment as they can, subject to keeping inflation under control. And the language used in the euro area is a little bit different, but it's the same basic goal. So these countries, these very big countries and big monetary areas, are going to have low interest rates for their own self-interested purposes. Does that have spillover effects on the rest of the world? Yes, absolutely. Are those effects unfair or unwise or unmanageable? No, I don't think so. I think it creates a different set of challenges for central banks in emerging markets and for fiscal authorities, but it can be managed.